In 1999, a taxi driver in New York told his passenger, a portfolio manager at a hedge fund, which technology stocks to buy. The passenger had been investing for 20 years. He listened to the driver, nodded politely, and went back to the office to start reducing his positions. In November 2021, millions of people bought a coin featuring a dog's face that had no revenue, no product, and no roadmap, and it felt genuinely, viscerally, like the smartest financial decision they had ever made. Two different markets, two different decades, one identical feeling. That feeling, that certainty, that clarity, that sense that everyone around you is finally seeing what you already knew, is one of the most reliable signals in all of financial history. Not a signal to buy more. A signal that the people with the most money are already in the process of leaving. History doesn't repeat itself, but it rhymes. Welcome to Hidden Patterns. Today we're going to map the emotion that appears at the top of every market cycle in history. Not the chart. We covered the chart fingerprint in the video above. Today, the feeling. Every market top runs through the same emotional sequence on its way there. Not every time at the same speed, but always the same direction, always the same stations. It starts with disbelief. The market has been going down for a while, or sideways, and when it first starts moving up, most people don't trust it. This rally isn't real. It'll reverse. Disbelief keeps most people out. That's why the early move is slow. Then hope. Maybe something actually is changing. The economy looks better. The technology is real. The asset has actual use cases. People start paying attention. Then optimism. Real money starts moving in. The price confirms the story. Every dip gets bought. Confidence builds. Then belief. Now the evidence is everywhere. The returns are real. The people who got in early are being celebrated. The stories are being written. Then thrill. Price is accelerating. The gains are larger than anyone expected. This feels different from every previous cycle. Maybe it is different. And then, at the top, euphoria. At euphoria, you are not speculating. You are certain. The math only works one way. The asset has broken free of old limitations. The people who are skeptical simply don't understand. You have never been more confident in a financial position in your life. This is what November 2021 felt like if you were holding crypto. What March 2000 felt like in technology. What the summer of 2006 felt like if you owned 3 houses in Florida. The feeling is identical across every top because human emotional architecture has not changed in 10,000 years. But here is what the economist Hyman Minsky figured out, and what most people still miss about this pattern. Euphoria doesn't just happen to coincide with the market top. It causes the conditions that make the top inevitable. The feeling itself is the mechanism. Minsky called it the euphoria stage, when rising prices convince investors that risk has been abolished. At that point, leverage spikes. Because why would you hedge something that can only go up? The system becomes fragile without anyone noticing because it feels like strength. But here is the layer that Wyckoff adds, the layer that explains who is on the other side of your confidence. Distribution, as Wyckoff described it, has a mechanical requirement. For every share or coin being sold by the operator, there must be a buyer, and the buyer must be willing to pay the high price. Who is willing to pay a high price with conviction? Someone who is experiencing euphoria. This is not metaphorical. The euphoric retail investor is the literal counterparty to the institutional exit. Smart money cannot sell a large position into a fearful or cautious market. There aren't enough buyers. It needs a crowd of people who are certain the price is going higher. The euphoria creates the liquidity the exit requires. On-chain, this is visible. In October and November 2021, while Bitcoin was making its final push to $69,000, on-chain data showed large wallets, holders of over 1,000 coins, moving assets onto exchanges at an accelerating rate. Moving coins to an exchange is preparation to sell. It happened at the exact moment retail volume and social sentiment were at all-time highs. That's the distribution fingerprint, the same one we showed on the price chart in the video above. The chart tells you the pattern. The emotion tells you which side of it you're on. The emotional cycle, the Minsky Mechanism, the on-chain fingerprint, three things that individually are interesting. Together, they're the same signal. Subscribe to Hidden Patterns. We decode one hidden market pattern every week. The next force is the hardest to see from the inside, because you're feeling it while it's happening. In 1720, Isaac Newton lost the equivalent of several $1 million in the South Sea bubble. He had sold his shares early, watched the price keep rising, bought back in at the top, and rode them down. Afterward, he reportedly said, "I can calculate the motion of the heavenly bodies, but not the madness of people." Newton wasn't foolish. He experienced the same feeling everyone else did. Certainty, late in the cycle, that the price was still going higher. His intelligence made no difference. In September 1929, an economist at Yale named Irving Fisher told reporters that stock prices had reached what looked like a permanently high plateau. He was one of the most respected economists in the United States. 3 weeks later, the market began the crash that would take it down 89% over the next 3 years. In 2006, Alan Greenspan used the word frothy to describe parts of the housing market. The word was ignored. Housing prices, the consensus held, could not fall nationally. They never had. 2 years later, they had fallen in every state simultaneously. In every case, the euphoric narrative was internally coherent. The fundamentals did look strong. The technology was real. The growth was real. That is what makes the late stage so dangerous. You cannot argue with it using logic, because the logic is correct. It's just wrong about timing. The only reliable countersignal, as Wyckoff showed, is the chart. The only emotional countersignal is learning to ask, who is selling to me right now? The uncomfortable truth is this. You cannot see this pattern from the inside while it's happening. The euphoria feels like clarity, not delusion. That's the point. But there is one thing you can learn to do. You can learn to notice when you feel certain. When a financial position gives you the sensation that it can only go one way. When the math feels obvious, when the people who disagree seem to be missing something, that feeling is data. Not a reason to exit immediately, but a reason to look at the chart for the tells we covered in the last video. A reason to check the on-chain data. A reason to ask who is on the other side. The market top doesn't announce itself with alarm bells. It announces itself with confidence. Your confidence. What asset in today's markets gives you that feeling of certainty? Tell me in the comments and subscribe to Hidden Patterns, because the next video breaks down the three-phase system that runs underneath every one of these cycles. Hidden Patterns, subscribe, and we'll see you in the next one.